swimming with the whales, who they are, their strategies, and how to leverage opportunities in the crypto world. In the vast ocean of the cryptocurrency market, certain players stand out as the massive whales who move large volumes and often dictate the direction of the waves. You see these headlines all the time: some unknown whale just moved $1 billion worth of Bitcoin, and everyone freaks out. But who are these whales? How do they operate? And most importantly, how can you, as an investor, learn to swim alongside them without getting swallowed? Look, I'm not gonna lie, the crypto market can be ruthless. It's like the Wild West out there, and if you're not careful, you can get eaten alive. But that doesn't mean you can't make money. In fact, some of the biggest gains are made by those who know how to follow the whales. Stick around until the end of this video, because today, we're uncovering the secrets of the whales and showing you how to turn their strategies into profitable opportunities. So, who are these whales we keep talking about? Well, in the crypto world, whales are individuals or entities holding a significant amount of a specific cryptocurrency. We're not talking about someone with a couple of Bitcoin here. A Bitcoin whale might own anywhere from 1,000 to 10,000 BTC or even more. To put that into perspective, at Bitcoin's all-time high, that's literally billions of dollars. Now these whales, they come in different shapes and sizes. Some are institutional investors like hedge funds and corporations, who see crypto as a new asset class to diversify their portfolios. Others are billionaires, you know the type, early adopters of technology, who saw the potential of Bitcoin back when it was just a few cents and rode that wave to unimaginable wealth. And then there are the OGs, the early adopters who got in on the ground floor, believed in the technology, and accumulated substantial wealth as the market grew. But here's the thing about whales: they're not just wealthy or lucky, they have the power to move the market with a single action. Think about it. When a whale buys or sells large amounts of a cryptocurrency, it creates a massive ripple effect. It's like dropping a boulder into a pond. The bigger the boulder, the bigger the waves. This is why understanding their strategies is so crucial, because if you can anticipate their moves, you can ride those waves to some serious profits. But on the flip side, if you're caught on the wrong side of a whale, well, let's just say it's not pretty. So, let's dive into some of the strategies these whales use to navigate the crypto waters. Now let's talk about the elephant in the room, or should I say the whale in the ocean market manipulation. Look, we all know it happens. The crypto market is still relatively young, and with less regulation compared to traditional markets, it's ripe for exploitation. And whales, with their massive holdings, have the power to influence prices in a way that most of us can only dream of. One of the most common tactics whales use is something called wash trading. It sounds complicated, but it's actually quite simple. They basically buy and sell the same asset at the same time, creating a false sense of volume and activity. This can trick unsuspecting investors into thinking there's more demand for a particular cryptocurrency than there actually is, leading them to buy in at inflated prices. Then there's spoofing, which is like a psychological game whales play with the market. They place large buy or sell orders that they have no intention of actually filling. These phantom orders create a false impression of market depth and can push prices in a certain direction. For example, a whale might place a massive sell order for Bitcoin, scaring smaller investors into thinking the price is about to crash. This triggers a wave of panic selling, driving the price down even further. And guess what? The whale then swoops in and buys up all that cheap Bitcoin, laughing all the way to the bank. But it's not just about these fancy tactics. Whales also understand the power of information and how to use it to their advantage. They have access to sophisticated trading tools, real-time data feeds, and often have insider knowledge about upcoming events or developments that could impact the market. This gives them a significant edge over retail investors like you and me. So, how do you avoid getting played by these whales? Well, the first step is awareness. By understanding the tactics they use, you're already one step ahead. Chapter 3. The Hot L Strategy, Playing the Long Game Like a Whale. Now, not all whale strategies are about quick pumps and dumps. Some whales play the long game, and they do it through a strategy that's become almost legendary in the crypto world: hodling. You've probably heard this term thrown around, maybe even used it yourself. It basically stands for hold on for dear life, and it's the digital equivalent of buying and holding stocks for the long term. The logic behind hodling is simple. Bitcoin and crypto in general is still in its early stages. It's volatile, yes, but it also has massive growth potential. Whales who believe in the long-term future of crypto are willing to ride out the dips and the crashes, knowing that, over time, the value of their holdings is likely to increase. And here's the thing about hodling, it's not just about patience, it's also about scarcity. Every time someone buys and holds Bitcoin, they're effectively removing it from circulation. This reduction in supply, combined with increasing demand, puts upward pressure on the price. It's basic economics, but in the crypto world, it's amplified by the fact that there's a finite supply of Bitcoin that will ever be created. Now you might be thinking, okay, that's great for the whales, they got in early and have tons of Bitcoin. But what about the rest of us? Well, here's the good news. You don't need to be a whale to benefit from hodling. Even if you can only afford to buy a fraction of a Bitcoin, or even just a few $100s worth, every little bit counts. The key is to have a long-term mindset. Don't get caught up in the hype cycles and the daily price swings. Instead, focus on accumulating your crypto holdings over time, through a process called dollar cost averaging. This means investing a fixed amount of money at regular intervals, regardless of the price. This way, you're buying more when the price is low and less when the price is high, averaging out your cost over time. Chapter 4. Pump and dump schemes. Don't get caught holding the bag. Alright, let's talk about the dark side of the crypto world, the one they don't want you to see. Pump and dump schemes. This is where things get shady, and unfortunately, it's a tactic that some whales use to take advantage of unsuspecting investors. Here's how it works. A whale, or a group of whales, will secretly accumulate a large position in a lesser-known cryptocurrency. We're not talking about Bitcoin or Ethereum here, but those obscure coins with names you can barely pronounce. They do this quietly, without drawing attention to themselves. Then comes the pump phase. They start spreading hype about this coin using social media, Telegram groups, even paying influencers to promote it. They'll create fake news, spread rumors about partnerships that don't exist, anything to create a buzz and attract unsuspecting investors, and people fall for it. They see the price skyrocketing, hear all the hype, and think they're missing out on the next Bitcoin. So they rush in, buying up the coin at inflated prices, hoping to get rich quick. This is exactly what the whales want. Once the price has been pumped up high enough, the whales pull the rug out from under everyone. They dump their massive holdings all at once, cashing out for a huge profit and leaving everyone else holding the bag. The price crashes, often just as quickly as it rose, and those who bought in at the top are left with huge losses. Pump and dumps are illegal for a reason. They're manipulative, unethical, and prey on people's greed and lack of knowledge. But they still happen, and they can be hard to spot, especially for newcomers to the crypto space. So, how do you avoid getting caught in one of these schemes? First and foremost, be wary of hype. If you see a coin suddenly skyrocketing in price and everyone's talking about it, don't just blindly jump in. Do your research, understand the project, the team behind it, and the fundamentals. If something seems too good to be true, it probably is. Chapter 5. Riding the waves. Diversifying and spotting whale opportunities. Now you might be thinking, this is all great, Andre, but how do I actually make money from all of this? Well, here's the thing. You don't have to be a whale to swim with them. In fact, you can use their movements to your advantage. Remember, whales are always looking for the next big thing, the next Bitcoin, the next Ethereum, and they're willing to invest early in projects they believe in. This is where you come in. By following the whales, by paying attention to what they're investing in, you can get in early on projects with massive growth potential. Now, I'm not saying you should blindly copy everything a whale does. That's a recipe for disaster. But you can use their movements as a signal, as a starting point for your own research. One way to do this is to track whale wallets. There are websites and tools out there that allow you to see the transactions of the largest holders of a particular cryptocurrency. You can see what they're buying, what they're selling, and how much they're holding. This information can give you valuable insights into market sentiment and potential investment opportunities. Another strategy is to follow whales on social media. Many whales are active on Twitter, sharing their thoughts on the market, their investment strategies, and even hinting at projects they're interested in. Now, take everything you see on social media with a grain of salt, but it can be a valuable source of information if you know where to look. But here's the most important thing. Don't put all your eggs in one basket. Just like whales diversify their portfolios, you should too. Don't just invest in one or two cryptocurrencies. Spread your risk across different projects, different sectors, and different asset classes. Swimming with whales might sound intimidating, but with knowledge and strategy, you can turn this coexistence into significant opportunities. Remember, in the crypto market, power lies with those who have information and patience. Don't get caught up in the hype, don't fall for get-rich-quick schemes, and always do your own research. If you enjoyed this video and want to keep learning how to ride the waves of this market, don't forget to like, subscribe to the channel, and hit the notification bell so you never miss out on new content. Thanks for watching, and I'll see you in the next dive into the crypto world.